why would a company sell pieces of itself? At first glance, that sounds strange. If a business is successful after all, then why give up ownership at all? To answer that, we need to understand what a stock actually is, why companies invented them, what ownership really gives you, how stockholders make money, and what risks do they accept in return. Let's start with the most basic question. What is a stock? A stock is a share. It is a fractional claim on the equity of a company. When you own a stock, you own a share of the company, a slice of the business, a piece of the pie. There are many ways to put it. That ownership gives you three possible claims though. First, a claim on the company's assets, in the case if the company goes bankrupt or liquidated. Second, you get a claim on profits, if the company distributes profits, such as dividends, for example. And third, a claim on growth, if the company reinvests its revenue, grows revenue or earnings, and increases its valuation, then the value of your shares increases as well. In practice, different companies emphasize different parts of these. Some mature companies generate very steady profits, and in return, parts of those profits are returned to shareholders as dividends. More often, these are slower growing companies, but more predictable businesses, such as the automotive sector or telecom sector. Other companies focus entirely on growth. They reinvest basically all their earnings back into the business instead of paying dividends, with the goal of becoming much larger over time. The technology sector is a prime example of this. And some companies fail. Revenues fall, profits disappear, and in extreme cases, businesses go bankrupt. In those situations, shareholders can lose parts or all of their investment. It is important to note that in everyday language, people usually say stocks, but the more precise term is actually shares, because what you really own is a portion of the business itself, a share of the business. The number of shares you own directly reflects how big your slice of the business is. But in summation, if the company does well, you benefit. If the company underperforms, so does your investment. So why would a company do this in the first place? Why sell ownership? Companies invented stocks in order to raise funds, to pursue business ideas without taking on the whole amount of risk themselves, and without providing all of the funding on their own. This is commonly referred to as raising equity. There are other ways of raising funds, such as debt, which involves bank loans, bonds, and other forms of borrowing. With debt, though, the company must pay interest and in the end repay the whole loan, regardless of whether the business succeeds or struggles. With equity, there is no fixed repayment. Instead, the investors share both in the upside and in the downside. Let me give you an example. I own a burger restaurant. The business is doing really well. But my customers also ask me for hot dogs. Now, as a business owner, I want to serve my clients instead of them finding alternative shops. So I analyze the hot dog business. It looks really promising, but I need to buy special equipment. It will cost around $30,000. I don't have that kind of money. I don't want to take a bank loan, so I decide to raise equity. Specialty banks then value my business and help create an IPO, which is an initial public offering. Let's say the business is valued at $100,000. We split that into 100,000 shares, each of them valued at $1. So I keep 50% of the shares and sell the other half on the stock exchange. Once sold, I raise 50,000 in cash, and I also expand the business. I make the best hot dogs in town now. But the investors now own part of the business. They share in the upside and the downside. So when you buy a stock, you're not buying a number on a screen. You are buying a share in a business, a claim on its assets, profits, and its future growth. That ownership comes with uncertainties, rather, and no promised returns. So they're not like bonds. But the reason stocks exist is simple. They allow companies to raise capital in order to grow. And they allow investors to participate in that growth by sharing both the risk and the reward. Markets can be volatile. Prices can move for reasons that have little to do with fundamentals. But underneath those price movements, a stock still represents ownership in real economic activity. That is what a stock is, and why companies sell pieces of themselves.